And you are watching PBS Books. Hi, I'm Fred Nahat. Nice to have you along with us for an all-new episode of our virtual series about financial and investor protection. This program is being generously funded by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education so that all Americans can be informed and make wise investment decisions at any stage of their life. State regulatory offices are playing a key role in this education series. You may or may not be familiar with the agency in your state, but each one works hard to protect citizens from fraud by regulating investment firms and investment products that are offered in each state. Security regulators are devoted to unbiased financial and investor education and offer a wealth of resources, all for free. Security regulators can't give investment advice, but they do provide the materials you need to make the best and most informed choice for your future. Many state regulator offices partner with the IPT and are joining us today to bring you this event. Here with us now is Commissioner of the Tennessee Department of Commerce and Insurance, Carter Lawrence.
Thank you, Fred. I'm excited to join you today. The Tennessee Department of Commerce and Insurance is the agency responsible for protecting Tennesseans through balanced oversight of fire safety, a variety of regulated professions, and the insurance and securities industries, all while enhancing consumer advocacy, education, and public safety. Our Securities Division regulates the securities industry and securities that are sold in, from, or into the state of Tennessee. The division's mission is to protect Tennessee investors from fraud and deceptive sales practices and to maintain the integrity of the state securities market. At the Securities Division, we believe that an informed and skeptical investor is the best tool to prevent fraud. And that's why we're proud to partner with this video presentation today to share new trends in investing, as well as tried and true strategies. We have a lot coming up in this episode, and joining us to moderate the event is veteran broadcaster Donna Lowry. Donna will be speaking to the panelists about the trendier investing strategies worth trying, as well as the classic investing techniques to brush up on. After learning about different investing approaches, Rachel Carden, our Tennessee Securities Division Director of Investor Education, will join you all in a group discussion of how to keep those investments safe from scams and fraud. Donna?
Today's event is all about investing what's new and what's not. Gone are the days of needing to go to a brokerage office to invest in the stock market. Now we all have cell phones, really handy for us. They can help us as we buy or trade stocks within minutes, all by ourselves. But even though the tools have changed, many investing principles from decades ago, they still apply today when it comes to retirement planning. So first up, the new smart investment strategies to try. There are certainly some differences in the way we can invest compared to, say, 30, 40 years ago. And joining us to talk about which trends to try and the risks, we got to talk about that associated with some of these new tools, is Joseph Brady from the North American Securities Administrators Association. Hey, Joseph.
Hi, good afternoon.
And then Matt Rolling, an adjunct finance professor at Wayne State University. Thanks for joining us.
It's a pleasure to be here.
And Julie Tavares, a writer and founder of Investing Latina. I'm so glad you're here too. So let's get started. Matt, I'd like to start with you and a topic that got a lot of media attention recently, and that is that GameStop trade bubble. That was kind of crazy when we were listening to it, but it happened. Tell us what exactly happened there and what can investors learn from it?
Wow, it captivated the nation for a week or two there, didn't it? Yeah. The GameStop kerfuffle, in my opinion, was an old battle fought on a new battlefield. The day after human beings invented financial markets, we invented market manipulation. And in this case, we had people on Reddit who were actively working on together to drive up the price of shares of GameStop and orchestrate a short squeeze that ultimately hurt a lot of large Wall Street hedge funds who had bet that shares of the stock would fall. Now, what was new here was that the manipulation was occurring out in the open on social media messaging boards, and that enthralled us, and it also made a number of people very wealthy. I think that the media like to portray this as David versus Goliath, and certainly few people cry when hedge fund managers lose a lot of money. But I think there were a lot of wealthy, powerful people on those Reddit pages as well. So I don't really like the precedent that the game story sets, because it glamorizes the stock market as a place where individuals can make fortunes quickly, when the data and research tells us that that's simply not the case.
Joey, let's talk about this a little bit more. Participating in any sort of speculative bubble is like gambling, right? And the mechanics of what happened to GameStop shares is not new, although I think maybe because of social media and all, maybe some people think it's new. So what role do state securities regulators play in helping investors avoid bad or risky trades?
So thank you, Donna. Fred talked a little bit about this in the introduction. My organization, the North American Securities Administrators Association, represents the state securities regulators in the US. You saw a slide at the beginning of the presentation with a map of North America. It had Canada and Mexico in it. That's from our website. Our members also actually include the regulators in Canada as well as Mexico. But on that page on our website at NASA, that's 2 A's at the end, not one.org. You can find information that'll direct you to the regulator in your state. Now, turning back to our members and what they do, you know, a lot of it begins with the investor, an informed and empowered investor. So in that regard, our members conduct investor education events. They go to the communities. Of course, that's not happening as much right now with COVID. But it'll pick up again. But they go into the communities and talk to investors. They explain what's going on in the markets, the things that they're seeing, the things that they're hearing about, and answer questions. Again, empowering and informing investors. Our members also will issue investor alerts from time to time. So whenever we're seeing, you know, a lot of activity around a certain investment that's concerning to us, or a potential scam or fraud that's in the works, we try to get the word out to our members. Our members get the word out to the investors in their communities. That's why it's such a great resource to go to their website, check it out from time to time, look for opportunities to engage with our regulator members. And also, those members serve as gatekeepers, Donna. They're actually serving a role when it comes to entering the financial services industry as a professional. So they license professionals. They test for minimum competence. They want to make sure that the individual knows what they're talking about, and that they also don't have any disqualifying events in their background. In that way, they help keep out sort of the bad guys, if you will. Now, that doesn't mean that every investment professional is always going to do right, but it's certainly having that gatekeeper in the front end is a way to help keep those actors out of this industry. And again, empowering investors, encouraging investors to ask questions, be skeptical, do your homework, do your diligence.
Yeah, I think a lot of people need to be reminded of those things. So NASA with 2 A's on the end is what we need.
NASA with 2 A's on the end, you got it, yeah.
All right. Julie, I wanted to talk a little bit to you. Driving up the sky-high GameStop trades this past January were investors on a platform called Robinhood. Tell us a little bit about it. How have robo-investors changed the investing landscape? And how can investors use them to help plan for retirement?
Yes. So when we talk about platforms like Robinhood, it's really important to recognize that these are still platforms that are in their infancy stage. So for a very long time, the places that we could go to invest were big institutions, the JP Morgan, Morgan Stanley of the world, the Merrill Lynches of the world, and they also had very high minimums to get started. It made people feel like you couldn't invest if you had little money to start with. However, with robo-advisors, that has all gone out the door, and people now understand that you don't need a lot to get started, which is exactly why so many people that were Robinhood users went ahead and bought GameStop. And the truth of the matter is that most of the people that invested into GameStop really didn't invest more than $250 individuals. The thing was that there were so many people that put in up to that amount. So it's really great, in my opinion, that we do have robo-advisors, that the system is changing and becoming democratized and more people can invest. I think it's a really powerful way to bring wealth into low-income communities, into people that maybe have felt that they didn't have the opportunity to build wealth through the stock market. But there are definitely a lot of risks that come with that. And the thing also about using platforms like Robinhood is the fact that they are sometimes missing that educational piece. So when we do have access to invest and invest as little as possible, or whatever it is that we have, or partial shares as an example, which is something that a lot of robo-advisors do, it really allows people to get in, but people start to get in without having a lot of knowledge. And that's what we want to try to kind of combat. We want to be able to educate more people. And it's really what I try to focus on doing with Investing Latina and the Investing Workshop, so that people can become more educated. It's okay to invest in some of these speculative things. However, you have to manage your risk. You have to understand how much of your money can you put into it. If you only have $250, at most that you should be putting into something speculative or something that is trending should probably be $25. So that kind of information is what I try my best to get out there, so people really understand, that there is a chance that you can lose your money when you're investing into things that don't have really a lot of legs to stand on, in a sense.
I want to take that a little bit further, Matt. Investors who would rather not buy into riskier stocks might look to well-established companies, only to find even one share is too expensive for them. And Julie talked about this a little bit. Fractional shares are available, though, through a few of the online brokerages, and they might be more affordable way to get started. So what are the pros and cons there?
Yeah, I just checked on the Yahoo Finance, and shares of Amazon are trading for about $3,300 right now. And as Julie mentioned, budgets for most retail investors might be as modest as a couple $100s. So if you wanted to buy a share of Amazon, you need over $3,000 historically. And so for most people, it's hard to hold expensive stocks like this as part of a diversified portfolio. So what a lot of brokers have now started to offer are these fractional shares, where the broker buys the share and they split it up into individual units so that their clients can more affordably invest in shares of expensive stocks like Amazon or Tesla. And this makes it a lot easier for people with more modest budgets to buy shares in these companies. I think it's wonderful. I think it adds to the narrative around the democratization of the stock market. One thing that people should keep in mind, though, is that because the broker is divvying up the shares, sometimes if the companies pay dividends, and those dividends either mathematically or otherwise are difficult to pass on to the individual investor, the brokerage account might end up keeping them, which can hurt the overall returns. So you might not experience the same returns as a person who held one entire share of Amazon. So again, there are some downsides, but I would say overall, fractional shares are a really nice way for your average retail investor to be able to participate in the market.
I think Matt made a good point, or the democratization piece, and owning a share of Amazon or owning a fractionalized share. I don't want to sound like a broken record, but perhaps I will a little bit in this space. He pointed out the issue with the dividends. I think you also want to be mindful of how owning a fractionalized share might impact your taxes as well when it comes time to sell those stocks or your fractionalized share in those stocks. So again, it's all about understanding sort of the ins and outs here, making sure you have a good grasp on, not the fact that you can just buy it fractionalized, but what it means if you need to get out of it.
Okay. All right. So Julie, another investment out of reach for many investors is Bitcoin. A lot of us are still trying to understand it totally. Its worth has grown exponentially in the last couple of years, so which might tempt some people to turn to other types of cryptocurrency. And so what's your message to folks who are considering investing in a digital currency?
Yes. So when we talk about the stock market, it's a place that you go to where you can buy shares of companies. When we talk about cryptocurrency, it's a completely different place. It's a completely different platform. And I first want to leave everyone with that message that it's two completely different things. I know that when you use robo advisors or investment platforms that are allowing us to buy partial and to kind of have a little bit of everything, the Robin Hoods of the world, the Weebles, the Acorns, and some of them are also offering cryptocurrency options. It's important to understand the difference between the two. We have a stock market that we've had for over 100 years, that there is a lot of history. There is a lot of data that we can kind of depend on. So there's information that we can use to study. Very different from cryptocurrency, that we really don't have that much data, that much information. When we think about the first time that cryptocurrency, specifically Bitcoin, came about, it was in 2008. So it hasn't been that long. It's been almost just 12, 13 years since that's been around. And of course, since then, it has had some highs, moderate highs, and many, many lows. So it was always seen as something that was very speculative, extremely risky. It was something that people that might have gotten in at the beginning were burned if they decided to pull out their investments. But there were also people that got in the beginning and have held for 13 years, long-term investing, right? That have profited a lot from it. So when it comes to crypto, all of the cryptos, and when it comes to deciding if it's the right thing for you, first, I think it's important to use the platform that has been around a while, understand how that functions, invest for the long term through the stock market, and then consider investing into crypto. Because as I mentioned, it's very different. There is less information that we can go off of. But the good thing, or at least the piece of information that we can use to kind of give us more confidence in terms of investing, is the fact that in the past and from the beginning, it was really just a people thing, a retail investor thing, and people that were really into the technology, the blockchain technology, and the idea behind crypto, which is really all about stepping away from our traditional financial systems. They were all for it, and they continue to be all for it. However, as of recently, and it kind of coincided with the pandemic, now big financial institutions are getting behind it. So it's a slight indicator to all of us regular people. If you want to get in, there are now more opportunities. And now there's a little bit more that we can depend on to kind of give us a little bit more confidence to say, okay, I can do this. But again, you always have to think about how much of your money do you really want to put into something that is just 8 years old and still, 12 years old and still growing, versus something that has been around for 100 years.
Yeah, so it may not be where you want to start.
No, I would never recommend anybody start there. Start with something that really has a lot of data, a lot of information. And we really do have a lot of experts in the stock market that we can find and reach out to and that talk about this stuff. There aren't still that many experts on cryptocurrencies. So that's still something that we have to kind of, establish.
Okay. Well, let's talk about something that's more established, Joey. IRAs. Individual retirement accounts, widely used for retirement saving and planning, and there are different types. Some comes with benefits, some come with risk. While self-directed IRAs aren't necessarily new, they do pose unique risks that investors should consider before taking on the asset. So what are the risks surrounding self-directed IRAs?
So let's talk about the risk, but before we do that, let's talk a little bit about what a self-directed IRA is. And Donna, I think you're exactly right. Most of us are familiar with the term or the concept of the IRA. We've thought about it in traditional IRAs or Roth IRAs, and I'll use traditional IRA here just to help us sort of frame the discussion, if you will. So the IRAs have custodians where assets are held, such as a brokerage firm or a bank. And while custodians for traditional IRAs allow us to hold investments such as stocks, bonds, mutual funds, CDs, things most of us are familiar with, a self-directed IRA custodian allows you to invest in what we consider or call alternative investments. And these can include, for example, things like investments in real estate, promissory notes, private placement securities, and even the thing we were just talking about, digital or crypto assets. Those investments come with their own sets of risk. We'll put those aside for a second and pivot back to the self-directed IRA. So going back to the role of the custodian, in the self-directed IRA, the custodian does not perform a lot of the duties that traditional IRA custodians perform. For instance, the self-directed IRA custodian doesn't generally evaluate the quality, the value, or even the legitimacy of the investment. It falls to the investor to perform that due diligence on the investment, as well as the person offering the investment. Now, some of the abuses that regulators have seen with regard to self-directed IRAs include, unscrupulous individuals who encourage investors to roll over money from their existing IRA, their Roth IRA, to a self-directed IRA in order to facilitate the investment in some of those very risky investments that I was just talking about, things like promissory notes, private placement securities. We've also seen the use of self-directed IRAs as a stamp of legitimacy for a fraudulent investment. So again, it's really important here when you see that term or when you see self-directed IRA, just don't automatically assume or associate that vehicle, that IRA, with the traditional or Roth IRA that we're all generally familiar with seeing. So again, there's information out there if you want to check it out. NASA issued an investor alert a while back on self-directed IRAs. The Securities and Exchange Commission has done as well. Just one word of caution: if you do begin Googling self-directed IRAs, you might find that you see some pop-up ads about the value of investing through self-directed IRAs. Just do your investigation, understand what they do and what they don't do, what they're there for, and why people may or may not have them.
Yeah. Thank you for that advice on making sure we watch out for those pop-ups. They're there for a reason. They're trying to.
They do, yeah.
Yeah, they're trying to pull you in. Okay, well, I want to thank you all for your information. It was very helpful, and I hope everybody learned a little bit about the new way of doing things. And now there's another great resource to help you better understand these new investment strategies. They are your local libraries. If you are feeling like you might be behind the 8 ball when it comes to retirement planning, don't worry. Fred Nahat, he is back with us on how to utilize those resources in your very own community to catch up to speed. And we all need that, Fred.
Donna, great conversation. Great thanks to you and our panel. Talking about some of the trendier tools in the market, looking forward to speaking on and listening in to you folks as you talk about more traditional tools that are still in style. All that is coming up. But first, let's hear from PBS Books Library Bureau Chief Heather Marie Montilla on the important roles, in fact, libraries do play in educating our communities and perhaps helping individuals reach investing and retirement goals. Here's Heather.
Especially in the last year, your local library has been working tirelessly to share quality content with its communities. And so they join us again today, live streaming this event, this gathering on their own social media channels, extending the message of today's important event. And as always, building on the important work they do for learners of all ages. PBS Books joins in this effort, and we are so pleased to help amplify today's work. We encourage you to share on your social media and also to visit our website at pbsbooks.org. Thank you.
All right, Heather, thank you. Great reminder on utilizing your local libraries and all of the resources there to help you better plan for a secure financial future. Let us once again welcome in Donna Lowry. Donna, our next panel coming up.
Yeah, absolutely. And we're excited now to turn our attention. We've talked about some of the new ways of doing things, but let's go back to some of the more traditional, the standard investing steps that have consistently helped build secure retirements. And you've probably heard about most of these traditional tips, and for a good reason. So joining us to talk about which ones make these so tried and true are Marguerita Cheng. She is a certified financial planner. Welcome. Dan Keady, he's a financial planning strategist. And then welcome to you and Laura Adams, a personal finance expert and award-winning author. And I want to thank you all for being here. So let's dig right in. Marguerita, I'd like to start with you. The investing world is daunting for millions of people. Let's face it. What's the best way to get started, particularly for someone who might have a smaller income or feel like they have very little to put away each month?
Well, sure. Some of these strategies are tried and true. So the first thing that I would encourage folks to do is take advantage of their employer-sponsored retirement plan. Now, if they don't have one, that does not mean they cannot save for retirement. They can start with establishing an automatic arrangement, and it could be as little as $50 a month. So where do you start? Remember, I would say the best place is your retirement plan. But if you don't have a retirement plan, you can establish an IRA, a traditional IRA, or a Roth IRA. The question is, do I save money in taxes today, or do I let it grow tax-free in the future? And that'd be the Roth option. As far as what options are appropriate, I think that investors, understandably so, are concerned about, making sure that they're planning for their future, but they're also concerned about market volatility. So I would say mutual funds, a target date fund, balanced fund can help take some of the market volatility out of the picture. So you're not trying to time the markets, but it's really the time that you're in the market, and you don't have to worry about picking that one hot stock. It's a diversified portfolio can help you build wealth for your retirement.
We'll get back into that a little bit more later. I want to get on to you, Dan. It's been said before, successful retirement planning isn't just about saving money. It's about developing good habits. And so what habits should all investors be striving for?
You know, it's interesting when you talk about new and then you talk about traditional. And myself, I go back now almost 40 years in the industry and have been a CFP since the 1980s. And for most of my career, Donna, I've been wondering, like, what works from the very beginning, what works and what builds wealth for people. And I would argue it's not speculation, but doing some very basic things, doing them well, and rinse and repeat. What do I mean? First of all, if you could work for a company that adds to the money you put into a 401k through a match, if you, again, increase the amount that you put in over time to your workplace plan, that can build for you. And then I would go into the real tried and true, and it goes back to diversification. Rather than trying to speculate on a given investment of some type, but really having a broad, diversified portfolio that matches your goals. And again, staying with it, controlling your emotions. I've seen many people bail out at the perfectly bad times. And the key is to control those emotions and work through it. So I would argue that many of the things that worked that I saw make people wealthy who started in the 60s and 70s, and I saw them in the 80s, will work going forward. And that's having patience, diversified portfolio, continuing to invest even when the market's down. Not intuitive, but if you put money in when the market's not doing well, you're actually buying shares cheaper. Again, that diversification, having that mindset of savings, of course, save now and often, but a lot of times you can really make this work for you.
Yeah, that patience is really important. There's a tendency when we see what's going on in the news to just kind of freak out about what's going on and not have the patience. So yeah, you're right. The diversification, the patience, all of those things are important. Laura, I want to get you into this conversation. Due diligence is also important when it comes to investing. So novice investors often shy away from certain wealth building assets after sustaining a loss. So how does one learn to do their due diligence, and what should they look for when researching retirement account options?
Right. Well, first of all, it's so great to be with you. I do think that we do need to think about what we're buying, what are we getting. Even if you're buying into your 401k, you still have a lot of options. You still have to make choices. So making sure that you understand what are the fees, looking at not only the retirement account fees overall, but the individual funds that you may be selecting, whether it's a mutual fund or an exchange traded fund, looking at, what are those fees that are built into that product. Ideally, you want fees that are as low as possible. That's going to help increase your profitability and your return on the investment over time. So if you've got, let's say, a menu at work through a 401k or a 403b, just look at, what's the most diversified, what are the lowest fees, and you can also ask your representative from that investment company to help you with that if you're really not sure. If you don't have a retirement plan at work, no problem. We have so many options these days, no matter if you're self-employed or you're unemployed or you are, taking a sabbatical, there are other options for you. So as long as you've got some amount of earned income, you can choose a Roth or a traditional IRA. And again, you're going to have a menu to choose from. So that's where you're going to look first. And if you don't understand what you're seeing, ask for help. In a lot of cases, the investment advice that you can get is free.
That's really good to know. And listening to this, being on this, watching our show right now is a good way to learn more. So Dan, let's learn more. We know that there isn't one retirement planning formula that works. We're certainly hearing that in today's conversation. So how can an investor determine the amount of risk they should take when it comes to their portfolio?
Donna, it's core to set up a portfolio that's going to match your goals, your risk tolerance. And one of the things that's so important is risk tolerance, but that's kind of how you feel. And I'd also like to address your capacity for risk right off the bat. I remember in the Great Recession, being on a radio show, an individual called in and they said they had the money in a stock market investment that they had to pay tuition in September. And this was, in the spring. So the first thing is understand what you're using the money for and only invest money that's going for the long term. It's easy to forget this if the market's going up. Let's go back to risk tolerance. Often, many firms will offer risk tolerance questionnaires, which are useful to understand how you feel about risk, or other model portfolios, which demonstrate their volatility. Those are all useless. But when I talk to individuals, I always say, well, tell me, what did you do in March with COVID when the market went down? Did you sell? In the Great Recession, did you sell? So part of it is kind of knowing yourself. But finally, it's important to remember risk capacity, which is often the time until you need the money. For example, my sons in their 20s have a very different time horizon or risk capacity than I do as I close in to retirement.
Yeah, good point. I'm often talking to my daughters about that same thing, that you're in a different phase of life than I am. So you have to look at life in a different way. So Marguerita, let's say someone did get burned with one asset or retirement account. How can you encourage them to begin building a more secure future again? Are there low risk investment strategies that you could recommend?
So I absolutely love what Dan was talking about, risk capacity and risk tolerance. I really try to make sure that the consumers, investors, have what I call risk alignment. So for somebody who has felt that they got burned in the market, I think the most important, a lot of people ask me, what's the best time to start investing? It's always a good time to start investing, but you need to go back and look at your time horizon. You also need to look at your risk capacity. And you also need to look at your cash flow constraints, meaning you don't want to take money that you need to pay your mortgage or your kids' college tuition bill. So a great way to start for somebody or rebuild would be what we call, dollar cost averaging. That is a fancy way of saying that you're going to automate your savings. So you're going to take a specific amount of money out every month and save that for your retirement. And so that takes the emotion out of it, meaning you don't have to think, okay, is today a good day? No, today's a bad day. So you pick a day. It could be the 10th of the month, and maybe it's $100. And then you can match that up with an investment that suits your needs. So more diversified, perhaps an asset allocation fund, and that means that it has stocks and bonds and so forth. So I tell people the most important thing is to start, but also recognize that you are rebuilding, and the best way for you to rebuild is to start investing again. And the last thing I'll say is sometimes, as Dan mentioned, the hardest part about investing is staying invested. So if you don't stay invested, you are not going to be able to participate in the recovery.
Yeah. So get involved, but then also, Laura, I want to talk about, we've talked a lot about diversity, but in our investments, but how often should we reevaluate our investment risk? And what role does that whole diversifying the assets play into managing a safe level of risk?
Diversification in your portfolio is everything. And I think that for most people who maybe are not equipped with the skills to really dig into what that means and calculate what they have, using the features that you may have built in with your investment service is an easy way just to put it on autopilot. So what I mean by that is if you set an allocation that you want, let's say you may say, I want a portfolio that is 75% stocks and some other assets to make up the balance, let's say bonds, cash, perhaps a little bit of real estate. You may be able to set that with your investment firm and then have it automatically rebalance for you every year. So that could be done quarterly, it could be done annually. So I'd say if you've got the option to set that and put it on autopilot, do it, because that means you're going to have all of that happening in the background where you don't have to concern yourself with it as the investor. You're just going to know that your portfolio is being rebalanced so that as the value of your stocks and bonds and all your investments change over time, that you're going to reset and get back to the desired level of diversification and allocation among stocks, bonds, cash, et cetera, that you choose, because that allocation is really all about your level of risk tolerance, which we've been talking a lot about. Stocks are the riskiest type of investment for most investors, yet we all need them in our portfolio in varying degrees in order to achieve the growth that we want to reach long-term goals like retirement. So I would say try to make it easy. Don't overcomplicate it. Let it be something that your investment service provides and automatically rebalances for you every year.
Okay, thank you very much. Dan, let's get you in on talking about the biggest investment mistakes that you see that people make, and how can we avoid them?
When we think of investment mistakes, this may kind of throw you off, but this is the biggest one that I've seen. And that is that people underestimate their longevity. In other words, many people, if you retired at 65, may live till they're 85, 95, or even 100. And we send out annuity checks to people who are over 100 years old. And because of that misunderstanding, often they'll take one of their biggest assets, and it is an asset, and that is your Social Security benefit. And they'll claim early as soon as they can, maybe at 62. And they're giving up potentially getting, call it 8% a year more income by delaying. And by delaying and getting a bigger check, that helps you protect against the longevity risk, against living too long. And it also takes some of the strain off the remaining portfolio because you have that bigger Social Security check, which is increased by the rate of inflation. So before anybody runs down and grabs the money as quickly as they can, it's important often to sit down with a CFP professional or others, or get one of the calculators and take a look at what delay could mean for you.
Yeah, and frankly, I hear so many people talking about that right now. When should I take Social Security? When should I? And it really is. I think it's different for every individual, right?
Yeah, you can't throw off one answer. That's true. But for many people, they're able to delay. Now, many people, unfortunately, they do not have the financial assets to delay, and they're really pushed into it, and they kind of have to start as soon as they can. And it's a major problem because those people's incomes at the lower end may not be enough to really help them with a reasonable retirement.
All right. Marguerita, to that same point, are there any myths or outdated investment strategies that don't make sense in today's markets?
Absolutely. I loved this question. So the first one is Social Security is going away. Take it as soon as possible. This is just to piggyback off of what Dan said. I would say that Social Security is probably going to have to change in its current state from its current state. It's an individual decision, but don't take it ASAP. So that, I guess, is myth number one. Myth number two, your taxes will be lower in retirement. That may not be the case because if you no longer have dependents, you've paid off your home, they may not always be lower, especially if you've done a good job saving. You may have be subject to required minimum distribution, so they may not always be lower. That's myth number two. Myth number three, retirees shouldn't invest in stocks. They're too risky. One of my clients, when she was 78, she said to me, she's like, Marguerita, I hope you don't tell me to be 100% in bonds. I know I'm 78 years old, but retirees like me are still long-term investors. So again, every investment has its risks. Stocks do have market risk, but they help address inflation risk or longevity risk. And I guess the last myth that I'm going to say is I'm set. Medicare is going to cover all my healthcare expenses in retirement. Again, everyone's situation is different. So we encourage people to make sure that they're not making decisions on myths.
Okay. I have enjoyed talking to all of you. I've learned a lot. I know our viewers have learned a lot too. Thank you all for being with us today. And I hope that everybody out there recognizes how important it is to think about their investments and talk to people like yourselves. I hope that happens with everybody. Thank you all so much.
Hi, everyone. Rachel Carden here, Director of Investor Education for the Tennessee Department of Commerce and Insurance's Securities Division. What a wonderful discussion with a lot of really great tips, a lot of things that stood out to me, and I made a couple notes as we were going through the session. But when you think about speculative investments, you want to be sure you manage your risk. And if the most that you have to invest is a certain amount, you want to make sure you're doing just a percentage of that, not the full. Also, the market is not a casino, and we should not treat it as such. And we hear this piece of tried and true advice over and over, but it stands the test of time. And that is the most important thing that you can do when it comes to investing is just to start. So now that we've learned some great investing tools, it's even more important we learn how to protect those assets that we work so hard for. And as Commissioner Lawrence mentioned earlier, we here in the Securities Division believe that the best tool to prevent fraud is an informed and skeptical investor. Part of our mission is to equip you with best practices, tips, and tricks to help minimize and avoid potential losses. So joining me to discuss ways to safely approach cryptocurrency investments is Marjorie Peerce from law firm Ballard Spahr. And also joining me to tackle the issue of managing risk and current scams is Tennessee Better Business Bureau President CEO Michelle Mason. Now, Michelle's bureau serves the Southeast region of Tennessee and Northwest Georgia. She's worked with several government agencies focused on outreach and investigations. And we appreciate you both being here with us. Thank you, ladies.
It's my pleasure. Thank you.
Wonderful. So first, Margie, let's start with you. We heard a lot about cryptocurrency today. It's not inherently bad, but because it is unregulated when it comes to the more traditional market, it comes with a lot more unknowns. So what are some classic information pieces that you usually share with folks when you're discussing cryptocurrency?
Well, first, I want to thank you all for having me here today. I would challenge the assumption that crypto is entirely unregulated. Commissioners of the Securities and Exchange Commission have been vocal about there needing to be more regulation and transparency so that investors have more guidance, but also they don't want to stifle innovation. So what is it that investors need to know? They need to know that crypto exchanges, at least if they operate in the United States, have to comply with the Bank Secrecy Act, as well as other regulations by the financial industry network called FinCEN, as well as any other state regulators. So one of the things for investors to look for is to make sure that where they're planning on putting their money, the exchanges are actually regulated by state and federal regulators, and that they have robust anti-money laundering and other practices in place to best protect your investor. A really important thing to know is cryptocurrency is extremely volatile. You probably all have watched what happened with Bitcoin over the past year, and the price has gone up in very rapidly, but it's also gone down very rapidly. Do not invest any more than you are prepared to lose. If you cannot withstand the volatility, then I would stay away from crypto. It is a very speculative investment. Another thing that people need to be aware of is what are the tax implications of investing in crypto? Because the Internal Revenue Service considers crypto to be property, and that is how it is to be treated on your tax returns. So make sure you talk to your tax professional before you start embarking crypto investments to make sure that you are investing in a sound, secure way and you understand the financial implications, aside from volatility, of doing such investments. Those are just some bits of guidance that I have for people who are thinking of investing.
And that's fantastic guidance. I'm learning and soaking in that knowledge myself while you're speaking of it. And it's really good to point out the regulation versus unregulated, because you hear a lot about that in the news. But I'm so glad you made those points, because it's just, it's different. It's different than traditional investments. And the most important thing is that we learn those differences and how we can leverage them. We just need to be prepared for volatility. So for those who do want to invest in crypto, you gave us a few pieces of advice, but could you go a little bit deeper into how they can safely approach it if this is something that they do want to work into their investment portfolio?
Well, sure. I obviously can't give investment advice, and any sort of investment involves some sort of risk. One thing to know is do not go ahead and buy a coin just because somebody is hyping it. The SEC is cracking down on companies that are hyping coins without disclosing they are getting paid for their endorsements. There have been a number of matters brought recently for people who are promoters, but the investing public does not realize that they are being paid for their endorsement. So look behind the curtain in terms of who is it that is pushing this coin? Are they getting paid for it? Do your homework. Do your research on the coin. Check the white papers that are issued in connection with coins. Make sure you look into the people who are behind them. Open an account at one of the well-regarded crypto exchanges. As anyone who's providing investment advice will say, only put in what you can afford to lose. And as I said a little earlier, due to the volatility of crypto, you should anticipate losing some or all of the value. So if you're somebody who's risk adverse, but you really want to get into this market, considering buy into one of the more well-known coins, if you like to gamble, you could try to get in on the ground floor of one of the newer, lesser-known coins, but do so with your eyes open.
That's fantastic. And, it's also the perfect segue to our next segment here. So thank you so much for that insightful information. We're going to briefly switch topics and, talk about managing risk. And when it comes to managing risk, it's about avoiding bad deals altogether. So Margie mentioned how important it is to do your research, do your homework, know what you're getting into. So let's talk about what managing risk looks like. And joining me now to tackle that issue is President and CEO Michelle Mason. Michelle, thanks again for being here.
Thank you. Thank you so much for the opportunity.
Wonderful. So here in Tennessee, precious metal schemes are something that is on the rise. So in March of this year, the U.S. Commodity Futures Trading Commission and 30 states, including our state here in Tennessee, shut down companies allegedly selling people gold and silver at inflated prices. What can you tell us about scams of these types?
Yes, we're definitely seeing these types of scams that are targeting individuals and unfortunately, especially our senior population. And they're really playing on people's fears about economic uncertainty. And their favorite target is someone who really has little knowledge about investing. So unfortunately, this creates a big recipe for high losses, maybe even someone's life savings. And in the case you were mentioning with the precious metals, that involved more than $185 million over 1,600 investors. And of the 185 million, we found that about 140 million came from people's investment or retirement funds. And they were using television, radio, social media ads, a variety of places to reach their victims along with other approaches. And I also wanted to mention that the way that they took the money was mainly through bullion coins. And in some cases, they were claiming that people were going to get a return of 300% over their true value. But unfortunately, that wasn't the case. And it's not just precious metals. We've seen other things too, like property and project type schemes. In fact, I remember one that attracted Alabama and Tennessee residents with a claim that they could invest in a shopping mall that was going to be built. People were taking a second mortgage on their home, or they were taking money out of their trust funds that they had for their grandchildren. And they thought they could grow that money. But unfortunately, the project didn't even exist. So they lost all their money.
Wow. Very unfortunate and tragic of a situation, but also another really great example as to why it's important to be aware of scams and frauds of this type. So what are some tactics that fraudsters use that investors should be on the lookout for?
Well, the precious metals case was a great example of how it can be pretty widespread. They were using, in some cases, fear tactics by scaring victims into thinking that their current investments were going to crash. But some of them actually used a form of trying to build a relationship through trust by trying to find some commonality with political or religious affinity. And we actually have a couple examples I thought I'd share with that case. In one particular case, we had an 82-year-old woman who said that a company representative scared her with claims that the stock market and mutual funds were the worst place to be. So as a result, she moved her entire life savings into gold and silver and ended up with a loss of 71%. We had another woman who complained to BBB that an employee of Tower Equity, which is one of the companies involved in this case, had reached out to her and initially claimed to be with the Republican House Committee. And then through subsequent calls, she was trying to gain some kind of, like I said earlier, commonality with a political position. She was even asking if she watched Sean Hannity on Fox News, and if so, had she heard about the Republican Gold IRA? And she called a few more times, even texted the consumer, trying to convince her to roll her investments over into an IRA, and especially that Republican Gold IRA. Thankfully, this woman was pretty savvy. She started doing her homework. She checked the phone numbers that were being used to contact her, and then found that they didn't even exist or go back to somebody.
Wow. Well, that's fantastic that she, really had a red flag go up and felt like she needed to do some more research. That's a really great example of knowledge working in favor of a good outcome. Do you have any tips that you can share on how to avoid becoming a victim of a case like this precious metals one, or even, any other specifically investor targeted scams?
We actually have quite a few tips. And the most important to us is to make sure that the investment is properly registered. So we're telling people to steer clear of any investment that should be registered with your state security division, and then you find that it's not. And then watch out for buzzwords. If someone's saying something is guaranteed or has little or no risk with high return, those are definitely red flags. We always say the devil's in the details. So if someone says they have a great opportunity for you, ask them to put it in writing, and that way you can review it first. And we always encourage people, make sure you're doing your homework. Don't let emotions lead your decision. And in the case of the shopping development that I mentioned, we found that if people had just done a little research to find out that the development never existed, nor was it registered with their state, they probably could have saved themselves all those losses. But as Margie mentioned, we also see some high pressure sales tactics like the false testimonials from a paid promoter. And those sometimes come in the form of what we call an opportunity meeting. You get that invite in the mail for a free dinner, but they can also come through phone calls, emails, text messages, advertisements. They may not always feel like high pressure, but in the end, that is really what they're trying to do. And also watch out for offers that are trying to get you to bring other investors with them, especially if you haven't done your own homework yet. Finally, we do encourage you to check out the opportunities with BBB at bbb.org. And again, check with your state regulator.
Wonderful. And the state regulator here in Tennessee is the Securities Division. So you can reach us at tn.gov/securities. And you mentioned those high pressure tactics. We're also seeing a lot of activity when it comes to social that's similar. You know, scammers are becoming more and more savvy, and they're using these social platforms to increase their interaction, and imposters are using this technology to their advantage. So really at the expense of an unsuspecting investor. So do you have some more information that you can share with us about how social is being used in that way to be a tactic?
Absolutely. We are finding that social media has been what we call a breeding ground for several investment promotions. And it's really easy for scammers to deploy their tactics and then disappear. And unfortunately, when you're online, it leaves no paper trail for law enforcement to crack down on these. So we want people to be very cautious. One thing that we're finding really getting its roots on social media is what we call a pyramid scheme, believe it or not. The most recent one being what we call a blessing loom. And their initial success can come through you being recruited by unsuspecting family and friends. So be aware that just because someone you know reaches out to you doesn't mean they've done their homework. As I mentioned, that's called a blessing loom. And how it works typically is that you're going to get a message from someone you know on Facebook, Messenger, maybe Instagram. And they're saying that there's an opportunity not only to invest money in a program that's going to give you huge returns, but also create a blessing for someone else. And that's where the name came from. But the reality is, as I mentioned, this is really an illegal pyramid scheme because there's no true product. It's just a matter of recruiting people to put money in place. And unfortunately, we find that usually the only people that make money off of this are the ones that start the scam. And as recruits run out, it collapses and most people are going to lose their money.
Yes, and it's like we've said before, if you are going to investigate into or invest, if you're going to invest into anything speculative or any investment for that matter, you need to be sure you're doing a percentage and not a large sum if that is not part of your investing strategy. So I know we could go for an entire session about scams. I know we could go for an entire session over cryptocurrency, but I'd like to bring both of you back because I'd like to ask if we can have just a bit of advice, like a key takeaway from you all to our viewers. And Margie, I will start with you. If you can leave us with one piece of advice, what would that be?
Well, as you've heard from both of us, there are people out there that are looking to take your money. And they're bad actors, as I referenced to them before. And so do your homework. Make sure that you can afford to lose the investment. Cryptocurrency is very exciting. It is an innovative way of spending money, but make sure that you do your homework and understand what it is you are putting your money into and that you can afford to lose all of it.
Fantastic. Michelle, same question.
Well, I want to reiterate again how important it really is to make sure you're checking out the investment and see if it is registered properly with regulators such as the Securities Division of the Tennessee Department of Commerce and Insurance. But I also want to give one BBB resource I haven't mentioned, which is our page called Scam Tracker. You can visit at bbb.org/scam tracker. And this site is designed for you not only to learn more about the types of scams that are being reported in your local community, but also throughout North America. You can do a keyword search and look for investment scams. And you can also report any attempts or fraud that you fall for that you want to share with others. So at least even if you lose something, you can warn others and help keep them from falling victim.
Fantastic. This has been some great information. I have so enjoyed our time together, and unfortunately, this is all the time that we have for today. I want to thank again our guest panelists for joining us. Thank you, Margie. Thank you, Michelle, and thank you for watching. Remember, utilize your local libraries for books, magazines, seminars, and any other materials, such as the When I'm 65 campaign, to help you figure out the best investing plan for your family. If you're looking for information about specific investing tools, go to investorprotection.org. And for more resources or to file a complaint about an investing concern, visit tn.gov/securities. Thank you for joining us.